When people hear about oil sanctions, they often think it's just a matter of politics between governments, or a headline that only matters to traders and diplomats. But here's something most people don't realize. Oil sanctions are like tossing a stone into a pond. The ripples spread far and wide, touching lives and economies in ways that aren't always obvious at first glance. The impact of these sanctions goes well beyond the borders of the countries directly involved. They can disrupt global supply chains, shift the balance of power in international markets, and even affect the price you pay for everyday goods, from groceries to gasoline. So, what's really at stake when the US targets Russian oil giants with sanctions? Let's break it down. These sanctions don't just target Russia, they send shockwaves through economies everywhere, from the bustling street markets of New Delhi to the traffic-choked avenues of Beijing, and even to the trading floors of London and New York. When a major player like Russia is hit with restrictions, the effects are felt in every corner of the globe. Oil is the lifeblood of modern economies, and any disruption in its flow can cause a chain reaction. Prices can spike, currencies can wobble, and entire industries can be thrown into uncertainty. For countries like India and China, which rely heavily on imported oil to fuel their growth, these sanctions are more than just a distant diplomatic spat. They're a direct threat to economic stability and energy security. That's why right now, India and China are watching every move with intense focus. For them, the stakes couldn't be higher. Both nations have built their economic engines on affordable energy, and Russian oil has become a crucial part of that equation, especially since the start of the Ukraine conflict. As Western countries have turned away from Russian crude, India and China have stepped in, buying up discounted barrels and keeping their industries humming. But with the latest round of US sanctions, the rules of the game are changing once again. Every headline, every policy tweak, every new restriction is being analyzed in boardrooms and government offices from Mumbai to Shanghai. The question on everyone's mind: how will this affect their access to energy, and what will it mean for their economies in the months ahead? This week, the US government announced a sweeping new set of sanctions targeting some of Russia's biggest oil giants, including Rosneft and Gazprom Neft. The goal is clear: to cut off a major source of funding for Russia's ongoing war in Ukraine. By tightening the screws on these companies, the US hopes to limit Russia's ability to finance its military operations and put pressure on the Kremlin to change course. But these aren't just symbolic gestures. The sanctions come with real teeth, blocking not only American companies from doing business with the targeted firms, but also threatening penalties for any global business that trades, ships, or insures Russian crude above a set price cap. This is a bold move, and it's sending shockwaves through the global oil market. The new rules mean that any company, no matter where it's based, could face US penalties if it's caught dealing in Russian oil above the price cap. That includes shipping companies, insurers, and even banks that finance these transactions. The message is clear: the US is willing to use its economic muscle to enforce these restrictions, and it expects the rest of the world to fall in line. For global businesses, this creates a climate of uncertainty and risk. Do they continue to buy Russian oil and risk running afoul of US authorities? Or do they pull back, potentially losing access to a major source of supply? The choices aren't easy, and the consequences could be felt for months, if not years to come. The markets didn't take the news lightly. Almost overnight, oil prices surged by nearly 5%, as traders scrambled to assess the impact of the new sanctions. The fear is that tighter restrictions on Russian oil could lead to supply shortages, driving prices even higher. For investors, this kind of volatility is both a risk and an opportunity. Some see a chance to profit from rising prices, while others worry about the broader economic fallout. But for ordinary people, the consequences are much more immediate. Higher oil prices mean higher costs for transportation, manufacturing, and just about everything else that depends on energy. It's a classic case of how geopolitics can hit you right in the wallet. Around the world, people are already feeling the pinch. At the gas station, prices are creeping up, making it more expensive to fill up your car or truck. In supermarkets, the cost of goods is rising as higher transportation costs get passed on to consumers. For families on tight budgets, this can mean tough choices, cutting back on essentials, postponing purchases, or dipping into savings. And it's not just individuals who are affected. Businesses too are facing higher costs, which can lead to layoffs, reduced investment, and slower economic growth. In short, the pain at the pump is just the tip of the iceberg. For India and China, the stakes are especially high. As two of Russia's biggest oil customers, they've benefited from discounted crude since the start of the Ukraine war. This has helped them keep inflation in check and support their economic recoveries after the pandemic. But now, with the threat of US sanctions hanging over their heads, both countries are treading carefully. They know that any misstep could lead to penalties, loss of access to US technology or financing, and even diplomatic fallout. At the same time, they can't afford to simply walk away from Russian oil, which remains a vital part of their energy mix. In India, oil refiners have reportedly hit the pause button on new Russian deals. They're seeking legal advice, trying to understand the risks and figure out how to navigate the new rules. For Indian companies, the stakes are high, not just in terms of potential fines, but also in terms of their relationships with both Russia and the US. The government is watching closely, weighing its options, and considering how best to protect the country's energy security. Some analysts believe India may look to diversify its sources of oil, turning to the Middle East or even the US for alternative supplies. But that won't be easy, and it could mean higher prices in the short term. Meanwhile, in China, energy giants are reviewing their contracts with Russian suppliers, looking for ways to minimize risk. They're acutely aware that losing access to US technology or financing could have serious consequences for their operations. At the same time, China has its own strategic interests to consider. The country has been working to build up its energy reserves and reduce its dependence on any single supplier. But with global markets in turmoil, even the best-laid plans can be thrown into disarray. Chinese officials are likely to proceed cautiously, balancing the need for affordable energy with the risks of running afoul of US sanctions. Both India and China have made it clear that they'll act in their own national interest. But the uncertainty is real, and it's creating a sense of unease in global markets. No one knows exactly how the situation will play out, or what the long-term consequences will be. Will India and China find ways to keep buying Russian oil without triggering US penalties? Will they shift to other suppliers, driving up prices elsewhere? Or will the sanctions force a broader realignment in global energy markets? These are the questions that policymakers, business leaders, and ordinary people are grappling with right now. In Europe, the mood is tense. The continent is already grappling with high energy prices and fears of another supply crunch. Analysts warn that the new sanctions could push more of the Russian oil trade into the shadows, making it harder to track and control. This so-called shadow fleet of tankers, operating outside the reach of Western regulators, could become even more important as companies look for ways to skirt the rules. The risk is that this could lead to more volatility, less transparency, and greater opportunities for fraud and corruption. For governments and regulators, keeping tabs on the global oil trade is becoming an ever more complex and challenging task. The bottom line is this: what's happening right now isn't just about oil. It's about the shifting balance of power in the world, the rise of new economic alliances, and the growing tensions between East and West. The decisions made in Washington, Moscow, New Delhi, and Beijing over the coming weeks and months will shape the future of the global energy market, and by extension, the global economy, for years to come. Every country, every business, and every consumer will be affected in some way. As world leaders gather for high-stakes negotiations and financial markets brace for more turbulence, one thing is clear: the era of cheap, stable energy may be coming to an end. The world is entering a new phase, one defined by shifting alliances, rising tensions, and a global market that's more unpredictable than ever. For now, all eyes are on India and China, as they weigh their next moves in a rapidly changing landscape. The choices they make will reverberate far beyond their borders, shaping the future of energy, economics, and geopolitics for us all.